Welcome to Trader TV. I'm Dan Barnes. Automation of the FX markets helps real money managers to lower the friction of hedging for equity and bond trades and potentially increases returns for hedge fund managers. We're asking Christopher Matsko, Head of FX Trading Services at FactSet, how the buy side can best take advantage of this evolution. Chris, welcome to Trader TV.
Thanks, Dan. It's a pleasure to be here.
FX trades can sometimes be an addition to other trades, particularly rates.
Right.
So how do you see FX trades working into the trading desk?
Our client base is generally trading FX for one or two reasons. It's usually either funding their equity or fixed income positions, meaning they've just got to pay for the trade on the other side of the shop, or they're hedging out those positions over a period of time, whether it's a month, a quarter, the year. So those require different types of contracts. Again, a lot of our clients are trading forward contracts or swap contracts. And they're generally there's a lot of them because they have a ton of portfolios that they have to manage. So it tends to be a very complex process in terms of just order management and making sure that when orders come into their blotters, they're efficiently maintained, whether it's through aggregation or netting or what have you, and then they can determine what's the best course of execution for those.
When long-only buy-side firms are looking at improving their FX trading, what are their key drivers?
FX is inherently a nuisance trade, as it were, and unless you're a shop that has an active overlay or is trading for alpha, in which case obviously there are positions being taken on either a macro or micro level. But really it's about how do we get this FX done at the most cost-effective way, at the most cost-effective time of day, and how do we validate that we're doing all these things to our investors? In our world, the multi-asset world, trading desks have to do more with less, right?
Yes.
And that's the thing. So they're being tasked to be multi-asset traders, generally speaking. So they're not only touching FX, they're touching FX in futures, or they might be even touching FX in equities or fixed income in FX, commonly. So because they have to wear these different hats, they're looking for the toolkit to make their job that much easier, right? And so gaining those efficiencies on the desk, so sort of going back and looking at those nuisance trades and automating those nuisance trades, that piece of it really can help the trading desk become more efficient very quickly.
So automation adds efficiency, but how do they bring automation into their current workflow?
Right. Well, it's simply one word: trust.
Right.
I mean, taking the fact that FX at its heritage was a very much a relationship-based business, taking away 20 years, 30 years, 40, of that trust and saying, I'm going to let a machine do this for me. Right. That is the biggest step that desks need to take. What do I trust the machine to do? Do I trust it to do a $2 million RFQ trade that I know is completely liquid and I know it's not going to affect the market? Yeah, I could probably trust it to do that. Can I trust a machine to automate this standing 4 o'clock fixing trade that I do? Yeah, I could probably trust it to do that. So let's start there. Let's start with that piece and see how that works. From an algorithmic trading perspective, a lot of our large buy-side clients are trading something called the WMR fixing trade. Right. Yep. So that's for those that don't know, that's the 4 o'clock fixing trade at the end of the London trading day, where a benchmark rate is basically established. And a lot of our clients are using that through algorithms. And what we're doing now is we're seeing a lot of clients say, well, that's just an easy trade. I mean, that's something that I just have to make sure it gets done at the end of the day. So what can I do to just automate that? So they'll use technology like ours to say, okay, when this trade comes in, I already know it's stamped for that time execution. I'm going to go ahead and just have your system go ahead and execute that at 4 o'clock, and I don't have to think about it. So from a tool set perspective, it's really looking at things like smart order routers and ways of just passing trades through the system and off to the market without any trader having to interact with them.
What do you see as being the latest tools in the transaction cost analysis ecosystem?
In-flight TCA is really where most people are focused at the moment, because they want to see their algos as they execute, or their positions as they're executing in the marketplace. And a lot of asset managers are using TWAP algos or passive algos, into the market. So they want to measure that cost as it fills over a period of time. And a lot of clients are using, again, their single bank platforms to go in and really look at that.
Yes.
Where if you can see that holistic view through a single framework, that's really ideal for most of our clients. So what they'll do is they'll watch, as their orders fill, and they'll measure that against a cost basis, and it's one that they can direct, right? So they'll look at cost versus arrival or cost versus sent mid, and they can see that as it tracks to the end of the algo fill, and whether they're using their bank's algos to track that TCA, or they're using something that we might offer in terms of in-flight TCA from a visual perspective, and they can again just sort of look and see where their trades are tracking.
How do you see the use of technology increasing the use of algorithms in this space?
Algos, again, have two main passes for liquidity, right? They can go, through a bank, and that gives you access to primary markets or ECNs that you might not actually see, or you can use an algo against, your own streaming liquidity, which might be your own credit counterparties and your own directed brokers, and that's great because, maybe in that instance you're not paying, for that as much for that execution type.
Sure.
And so if you're not paying as much for the execution type, maybe it's more value to sort of look down that avenue and say, can I get my cost lowered by just going direct to my counterparties, but using a smarter algo to do that?
How do you see long-only buy-side firms bringing streaming liquidity into their trading workflow today?
It's an avenue of liquidity that the real money community just hasn't been exposed to, and it's for good reason. The tool sets that have been around for the past 10, 15 years haven't allowed them access to streaming liquidity. What we're seeing as the small trend now in this community is the analysis between what's my risk transfer price look like in an RFQ versus a stream. If I were to take that size from 100 to, let's say, 7 or 10, in G10 or G5 currencies, just as a start, do I get a better, more thoughtful execution in the stream versus the RFQ? Or do I get a better spread, or do I get the same spread? And if I do, is it better for me because I'm not disclosing my risk to market participants? I'm getting it done against a stream where nobody knows that I've executed. My sell-side counterpart gets the benefit of me executing with them and the others not knowing that I've executed with them, so they can offset that risk in the market elsewhere without market impact to them.
Chris, that's been great. Thank you very much.
Thanks, Dan. I really appreciate the time.
I'd like to thank Christopher Matsko for his insights, and of course you for watching. To catch up on the other markets we cover, or to subscribe to our newsletter, go to tradietv.net and etftv.net.